Good morning. This is Manu, Walia, Managing Partner of Continuum Global Asset Management. It's May 24th, about 9:30, and I want to bring in the market commentary for today based on the current situation that's driving these markets. Before I go ahead, while I was preparing for this morning's commentary, I started thinking that there's been a lot of changes in technology over the last 20, 30, 40 years, and maybe that's one of the reasons that the volatility of the market is so much higher. For instance, over the last decade, the advent of internet, the reduction of prices in telecom, communication overseas, and so on and so forth has brought people together. We can go online and look at the most recent news and react to it. We can trade online. We have access to a lot of information. But then I started making some comparisons to 1929, mid-60s, the 70s, and I felt that the percentage volatility in major broad-based indices has not changed dramatically. There's been events in 1987 when the markets lost 22, 23% in one day. 1929, there wasn't any TV or internet, at least to that extent that we have now. Telecommunication was very, very restrained and constrained compared to current measures, but still we had these market turmoils. I believe that currently what we're facing in the euro is pretty analogous to what we faced in 2008 and early 2009 in the US. The subprime market, the real estate market, which took a toll on the US markets, and especially the banking system, took a major toll, or is taking a major toll, in Europe. Now, needless to say that that's going to impact the European economy. We've got to recognize that the major governments, and when I say major governments, governments who are in the position to do something about this crisis are actually doing it. The United States came out with a fiscal package about 12, 14 months ago, which helped the markets alleviate the short-term pain, and now the European Union is primarily doing the same. Obviously, they have to work the kinks off. You know, the more prosperous countries like Germany are going to have some resistance in just letting go of money. But I think the most important thing to focus here on is the impact of this on investor sentiment. As we move forward, people will start feeling more and more comfortable, and if investors slash capitalists feel more comfortable, they're more prone to conduct business as usual. If they do that, then I guess the human element of progression comes into being, and we can deal with a lot of problems without panic. Having said all of that, I still believe that markets do operate on fear and greed, and we go through times of great happiness, prosperity, and greed comes into play. Once that happens, then people start to be fearful of giving up those gains and hence become selfish and start taking profits. I believe that based on the government intervention, based on the revival of the US economy slash the global economy, based on the improving unemployment situation here at home, based on a contained wage inflation because of competition from China and India, the overall global economy seems to be in a very robust position. I think that there will be more and more disposable income generated in emerging countries like China and India, some of the BRIC countries, which includes obviously Brazil and Russia, and a lot of consumption will take place in those areas. We've mentioned it on our market commentary umpteen times that that is the place to be in for longer term investors, and for shorter term investors I believe there are sectors in the United States and even in Europe that investors can take advantage of, but they have to be nimble and flexible to harness those gains and not just ride it forever and be a victim of this volatility. If you have any questions or you have critique on our market commentary or any other aspect of our website, feel free to give us a call at 661-299-1920, or you can email us through our website, which is www.cgamadvisor.com. Thank you for listening, and you have a